Good morning. I'm David Reese, Chair of the New York City Rent Guidelines Board, and I'd like to welcome you to this virtual meeting of the board. This is the first meeting in a series of public meetings and hearings to determine renewal lease adjustments for rent-stabilized housing units in New York City, with leases commencing or being renewed on or after October 1st, 2022, and on or before September 30th, 2023. On behalf of the board, I would like to take this opportunity to welcome two new members to the RGB. Good morning. I'm David Reese. I'm sorry, Brian, should I continue?
Yeah, David, I think you should just continue.
That was a gap. I'm sorry.
Okay, no worries. On behalf of the board, I would like to take this opportunity to welcome two new members to the RGB, public member Arpit Gupta and owner member Christina Smith. I look forward to working with you both in the coming days and months. I will now take roll call. Please respond if present. Christina DeRose.
Present.
Robert Ehrlich.
Present.
Shayla Garcia.
I'm sorry, present.
Thank you, Robert. Shayla Garcia.
Present.
Christian Gonzalez Rivera.
Present.
Arpit Gupta.
Present.
Alex Schwartz.
Present.
Christina Smith.
Present.
David Reese, present. With the arrival of new members, I would be remiss if I did not recognize the contribution of the three members who have left our board, Leah Goodridge, Cecilia Hossa, and Scott Walsh. I would like to recognize their hard work and dedication to the RGB. So on behalf of the current members, I would like to thank them and wish them well. Currently, there is a tenant member vacancy on our board. City Hall is aware of the vacancy, and we hope to have a new tenant member in place for our next meeting. Our next virtual meeting will be April 14th, starting at 9:45 a.m. Please note the later start time. Information on how to attend this meeting will be posted on our website, nyc.gov/RGB, in our meeting section by the Friday prior to the meeting, and at the same time will be sent to those who are on our email list. If you are interested in receiving email updates about upcoming RGB meetings and hearings, please go to our homepage and click on RGB email updates under quick links. Today, staff will present the 2022 income and expense study. This report will be posted on our website after the meeting. Just click research on our homepage to download these reports. Please note that the annual filings of the Conflict of Interest Board Financial Disclosure Report 2021 filing period will be from April 18th through May 13th. New board members, Andrew will be able to kind of explain that process for you, and we will send the packets to each board member in the next few weeks. I will now introduce Brian Hoberman, the RGB Research Director, who will be presenting the 2022 Income and Expense Study. And I would just say to our members, but really to our new members, feel free to interject with questions or comments, or to save them to the end of the presentation. And we'll take it. We'll hand it over to Brian now.
And can I just jump in for 1 second, David?
Yeah.
I just wanted to show people how that they, once they get to our site, that they can join our email announcements. So I'm just going to share my screen quickly here and just walk that through for people who want to join, sign up for that. So this is our home page. Under quick links, you'll see sign up for email updates. You simply click on that. And then this link here will go right to the sign up webpage, which then at that point you would put your email in, if you like, first name, last name, and zip code. And any announcements that the board will have you'll be receiving when our meetings are, our voting meetings, and when our reports are up and things like that. So anyone who's interested, who's watching our video today, please, we encourage you to sign up. Thanks.
Brian, on to you.
Okay. Thanks. Can everyone see the slide?
Yes.
Okay, great. Good morning. My name is Brian Hoberman, Research Director. I'll present the 2022 Income and Expense Study. First, I'll briefly review the methodology used in this study. The building owners are required to annually file RPIE forms with the New York City Department of Finance, with some exceptions. These include condos and other kinds of buildings, residential buildings smaller than 11 units, or buildings that have an assessed value of under $40,000. The Department of Finance matched 2021 RPIE filings with New York State Homes and Community Renewal Building File that contain at least one stabilized unit. And in order to get the sample used in this report, then the data was screened for errors and those records were removed. The two data sets created were the main RPIE analysis of 14,828 buildings containing 684,597 units. This data is used to compute average revenue and costs for a moment in time view. And then we have the longitudinal analysis with 13,969 buildings containing 648,560 units. This encompasses 2 years worth of RPIE filings. In 2020, property owners collected monthly rent averaging $1,422, and the median rent citywide was $1,280. Sorry. In previous years, I'm sorry, I'm having a little problem with the presentation. Okay, sorry about that. As in previous years, units in pre-war buildings rented for less on average, $1,310 per month, than those in post-war buildings, $1,676 per month. At the borough level, the average monthly rent in buildings containing stabilized units was $1,870 in Manhattan, at $2,363 in Core Manhattan, and $1,369 in Upper Manhattan. It's $1,372 in Queens, $1,367 in Brooklyn, $1,115 in Staten Island, and $1,053 in the Bronx. The average monthly rent in the city, excluding Core Manhattan, was $1,288. Many building owners supplement income from their apartment rents by selling services as well as by renting commercial space. In 2020, building owners in New York City earned an average of $1,580 per unit. The citywide median was $1,389. Pre-war buildings earned $1,458 per unit, and those in post-war properties earned $1,857 per unit. Gross income was highest in Manhattan at $2,172, with $2,636 in Core Manhattan and $1,579 in Upper Manhattan. In the remainder of the city, Brooklyn's gross income was $1,458, followed by Queens at $1,452, Staten Island at $1,222, and the Bronx at $1,177. Monthly income in the city, excluding Core Manhattan, was $1,388 per unit. This graph shows that average monthly income and rent were highest in Core Manhattan and lowest in the Bronx. Core and Upper Manhattan are both shown at the top, and the city without Core Manhattan is shown at the bottom. Average income is in gold and average rent in green. And as with all the graphs and tables in this presentation, they're also in the report itself. Gross income encompasses all revenue from rent, including apartment rent, commercial rent, such as retail space and cell phone towers, sale of services such as laundry, parking, and vending, and all other operating income. The sale of services and commercial income accounted for 10% of the total income earned by building owners in 2020 citywide, down 0.8 of a point from the previous year's 10.8%. By borough, income earned from services and commercial rents as a percentage of total building income was 13.9% in Manhattan, with 14.2% in Core Manhattan and 13.3% in Upper Manhattan. It was 10.5% in the Bronx, 8.8% in Staten Island, 6.3% in Brooklyn, and 5.5% in Queens. In the city, excluding Core Manhattan, the proportion was 7.2%. The average monthly operating costs for units was $1,035 in 2020. Median monthly cost was $937. Costs were lower in units in pre-war structures, $997, and higher among post-war buildings, $1,222. By borough, average costs were highest in Manhattan at $1,451. Within Manhattan, costs for units located in Core Manhattan averaged $1,752 a month, and costs in Upper Manhattan were $1,066. In the other boroughs, Queens was at $934, Brooklyn at $895, the Bronx $811, and Staten Island $810. Excluding Core Manhattan, the average monthly operating cost for stabilized building owners in New York City was $900. Now, this graph breaks down expenses by component and further splits them into pre and post-war categories. The largest share of expenses went towards taxes, followed by maintenance and administrative costs. Post-war buildings, indicated in this graph in green, spent more on taxes, maintenance, administration, labor, and miscellaneous costs. Pre-war buildings, shown in gold, spent more on fuel, utilities, and insurance. The average expenses per unit per month for all buildings is shown in red. Buildings where total operating and maintenance costs exceed gross income are defined as distressed. In 2020, 6.5% of buildings were considered distressed. That was a 1 percentage point increase from the prior year's 5.5%. By borough, 56.6% of distressed buildings are in Manhattan, while the remaining buildings are in Brooklyn with 16.6%, the Bronx, 15.7%, Queens, 10.6%, and Staten Island, 0.5%. Since 1990, when 13.9% of stabilized properties were considered distressed, the proportion of distressed buildings declined to as low as 4.9% in 2016. The proportion of distressed properties has since risen in each of the last 4 years to the most recent 6.5%, the highest level since 2013. Revenue exceeds operating costs in nearly all buildings, yielding funds that can be used for mortgage payments, improvements, and/or pre-tax profit. The amount of income remaining after expenses are paid is typically referred to as net operating income. NOI is a good indicator of a building's overall financial health. In 2020, apartments and buildings containing stabilized units generated $545 of net income per month, with units in post-war buildings earning more, $735 per month, than those in pre-war buildings, $461 a month. Average monthly NOI in residential-only properties citywide was $490 per unit, 10.2% lower than the average for all buildings containing stabilized units. In 2020, average NOI was significantly different by borough. The average monthly per unit NOI is greater among stabilized properties in Manhattan at $721 than for those in the other boroughs, which was $563 in Brooklyn, $518 in Queens, $412 in Staten Island, and $366 in the Bronx. It was a notable difference when looking at NOI on a subborough level in Manhattan. Core Manhattan properties earned on average $884 per unit per month in NOI, 72% greater than properties in Upper Manhattan, which earned an average NOI of $513. The monthly NOI average, calculated citywide, excluding Core Manhattan, was $488. In addition to NOI, another way to measure a building's financial health is to measure the cost income and cost to rent ratios, which, as the graph shows, closely mirror each other. Cost income ratios can be used as a tool to evaluate a building's financial health, assuming that buildings are better off by spending a lower percentage of revenue on expenses. In this graph, the audit adjusted cost income ratio is shown in green, the bottom line on the graph. These figures show audit adjusted numbers. In 1992, the Department of Finance audited expenses reported by building owners on RPI forms and found that costs were overstated by roughly 8% on average. In 2020, operating costs were 60.2% of gross income, down from 60.4% the prior year. The cost to rent ratio, which is the gold upper line, also declined, falling from 67.8% last year to 66.9%. Unaudited ratios are discussed in the report, and they follow similar trends as shown in this graph. This slide breaks out rent, income, costs, and NOI figures between Core Manhattan, which is on the left side, and the city with the core excluded, which is on the right. The graph shows that average rent, income, costs, and NOI are a great deal higher in Core Manhattan compared to the rest of the city. However, looking at cost to income ratios and a turnaround from prior years, Core Manhattan owners spent a higher proportion of their income on expenses compared to owners in the remainder of the city. Core Manhattan owners spent 61 cents of every dollar earned on expenses, almost 1.5 cents more than owners in the remainder of the city, who spent 59.6 cents of each dollar earned on expenses. This graph shows the income adjusted change in citywide income, rent, expenses, and NOI over a period of 3 decades. Since 1990, the income shown nearest to the top in gold, cumulatively increased in inflation adjusted 37.2%. Rent, the second line from the top in red, rose 38.1%. Costs, the third line in green, grew 32.7%. And net operating income, represented by the lowest line in orange, increased by 46.6%. These graphs represent the same time period as the graph on the last slide, but break it down by borough. It shows that while the actual inflation adjusted income, rent, cost, and NOI figures are far higher in Manhattan, the percentage increase in NOI since 1990 was the lowest among the boroughs in Manhattan. Brooklyn, at the top right, saw the largest NOI increase over the period, with NOI more than doubling, rising 137%. Queens, at the bottom left, had the second highest NOI increase, rising 74%. The Bronx, at the bottom right, experienced NOI growth of 66%. And finally, Manhattan, shown at the top left, saw NOI grow by 24% since 1990. We will now move on to the second part of the income and expense study, which is the longitudinal analysis. The longitudinal sample encompasses properties that filed RPI forms reflecting conditions in both 2019 and 2020. By conducting the longitudinal analysis, we can more accurately track changes from year to year as the same buildings are being analyzed. Average rent collections in buildings containing stabilized units fell by 3.8% from 2019 to 2020. Rent collections in post-war buildings fell at a lower rate, down 2.9%, than pre-war buildings, which declined 4.4%. Rent collections fell the most among 11 to 19 unit buildings, declining 5.6%, followed by large 100 or more unit buildings, down 4%, and mid-sized 20 to 99 unit buildings, down 3.4%. Examining rent collections by borough, Staten Island was the only borough to see rent collections increase, up 0.5%. By comparison, the largest decline was Manhattan, falling 7.4%, followed by Queens, down 2.1%, the Bronx, down 1.7%, and Brooklyn, down 1.2%. Within Manhattan, core Manhattan rents fell more, down 8.9%, while upper Manhattan rents fell 4.2%. Rent collections in the city, excluding core Manhattan, declined 2%. And the decline in median rent citywide was 2.8%. At the neighborhood level, only 4 neighborhoods saw a growth in average rents. Bushwick, Brooklyn, up 3.2%. Throgs Neck Co-op City in the Bronx, up 1.4%. And Sheepshead Bay, Gravesend, Brooklyn, up 0.5%, as well as the Rockaway, Queens, also up 0.5%. The remaining districts experienced a decline in average rents, most significantly in Manhattan. 10 of the 11 largest declines in rent occurred in Manhattan neighborhoods. The largest decline was in Chelsea, Clinton, down 12.4%, followed by the Lower East Side, Chinatown, down 12.1%, Midtown, down 11.9%, and the Village, down 11.5%. A list of all community districts and how much the rent changed can be found in the report's Appendix 13. The average total income, comprising apartment rents, commercial rents, and sale of services, fell 4.6% from 2019 to 2020. Revenues fell more in pre-war buildings, down 5.5%, compared to 3% among post-war buildings. Like the change in collected rent, only Staten Island saw income increase, up 0.4%. The largest income decline was in Manhattan, down 8.9%, followed by Queens, down 2.2%, the Bronx, down 1.9%, and Brooklyn, down 1.2%. Within Manhattan, core Manhattan income fell the most, down 10.7%, while upper Manhattan income declined 4.7%. Total income in the city, excluding core Manhattan, fell 2.2%. The median decline in income citywide was 3%. Average expenses declined 2.8% from 2019 to 2020. Pre-war buildings saw a larger decline in expenses, down 3.3%, while post-war buildings experienced a 1.8% decline. However, the decline in operating costs varied by borough. Costs fell the most in Manhattan, down 3.9%, followed by Queens, down 2.5%, Staten Island, down 2.3%, and the Bronx and Brooklyn both falling 2%. Within Manhattan, Upper Manhattan costs fell more, falling 4.5%, while costs declined 3.6% in Core Manhattan. Operating costs in the city, excluding Core Manhattan, fell 2.5%, and the median citywide expenses fell 2.6%. It can be useful to compare the cost changes calculated from RPIE data with the price and cost data from the price index of operating costs, which was adjusted to match time periods between the two in this graph. The adjusted PIAC is in gold, while the RPIE data is in green. As the graph shows, the income and expense data grew at different rates than the price index in some years since 1990. In the most recent year, the PIAC grew by 3.5% from 2019 to 2020, the same period as a 2.8% decline in I&E costs, a 6.3 percentage point difference. Net operating income refers to the earnings that remain after operating and maintenance expenses are paid, but before payment of income tax and debt service. Citywide NOI in buildings containing stabilized apartments decreased by 7.8% between 2019 and 2020. It was the fourth time NOI declined in the 30-year history of this study. Citywide, NOI in post-war buildings fell 4.7%, while older pre-war buildings declined by 9.8%. The average change in NOI varied throughout the city. NOI increased in Staten Island, where it rose 6.4%, as well as in Brooklyn, up 0.1%. However, NOI declined 17.5% in Manhattan, 1.8% in the Bronx, and 1.6% in Queens. Within Manhattan, NOI fell 22% in Core Manhattan and 5.2% in Upper Manhattan. Monthly NOI in the city, excluding Core Manhattan, fell 1.5%. At the community district level, NOI rose in 30% of the city's neighborhoods. Greatest growth in NOI occurred in Bushwick, Brooklyn, rising 12.1%, followed by Throgs Neck Co-op City in the Bronx, up 9.7%. The Rockaways in Queens, up 8.7%. East Tremont Belmont in the Bronx, up 7.4%. And Kew Gardens Woodhaven, Queens, up 7.1%. By contrast, not a single Manhattan neighborhood experienced an increase in NOI. 5 neighborhoods in Manhattan saw the greatest drop in NOI. Midtown, down 44.1%. The Village, down 32.4%. Chelsea Clinton, down 32.2%. The Lower East Side Chinatown, down 32.1%. And Stuytown Turtle Bay, down 26.7%. In each of the other boroughs, the neighborhoods seeing the largest declines were in Jamaica, Queens, down 21.9%, Park Slope, Carroll Gardens in Brooklyn, down 10%, and High Bridge, South Concourse in the Bronx, down 9.2%. A list of all community districts and how much the NOI changed can be found in Appendix 13. This table lists the average annual change in rent, income, expenses, and NOI from 1990 to the present. To summarize the findings of the income and expense study, from 2019 to 2020, citywide average rents fell by 3.8%, revenue collections decreased by 4.6%, and expenses declined by 2.8%. Since income dropped at a greater rate than costs, NOI citywide declined by 7.8%. The fourth time NOI declined in the last 30 years of the study, and the second largest decrease in NOI in the study's history. And just as a reminder, with all the other tables, and as with the other tables and graphs, this table can be found in the report for closer analysis. Thank you, and I will now take any questions you may have.
So before we jump into questions, I would just like to say, and again, this is particularly for the new members, there's a lot of information, a lot of data. just want to say there's no dumb questions, and kind of going over and making sure you really understand what you think is important is totally worth spending our time. Those who have served longer will also probably jump in to give their interpretation of events, but I'm just hoping that we kind of have a free form conversation where people try to get their hands around understanding the implications of this data. And so I'll turn it to everyone else for questions.
Hi, I have a question. So I'm curious, I guess from the owner members or anybody else, what were some of the on the ground drivers of that big drop in NOI, particularly in core Manhattan?
I'm not sure if that's, do you asking the other board members or me?
Yeah, I'm asking you or anyone else. Yeah. What are some of the drivers?
Well, I mean, looking at the data, I mean, core Manhattan was certainly hit hardest by rent declines and a decline in commercial income. So
I think also something that's not reflected in the study is that in June of 2019, the HSTPA was passed, which had serious implications on an owner's ability to renovate apartments and increase rents, which left kind of all of us here with the responsibility for 100% of any increase in rents that will happen going forward. So this report is actually the first report reflective of that huge change at the legislative level. And so that could certainly be impacting. You know, I certainly have some questions about taxes and how the changing subjects here, but the taxes declined by 9% per unit. And I'm curious to know how that was calculated. And we can kind of take the first part of my comment and then talk about the taxes. But I'm curious about both things, and certainly think HSTPA and the passage of it as of June 2019 is in the data.
I have a sort of an addendum to the question as well. I mean, it's like, to what extent, to the extent that you know this, to what extent is there a correlation between people who left town, basically, and vacated their apartments, and where the drops in NOI happen? I mean, it's like, is there a correlation between those two pieces?
Yeah, I'm not sure if we look at that in terms of vacancies. The HVS may shed light on that when that comes out, but in terms of the actual reason why specific neighborhoods decline more, is it because of people leaving? I mean, probably yes. I mean, but I don't have any insight into that.
Okay, I'd certainly be curious to find out if it's possible to get data that shows the relationship between those two things that happened at that time.
Yeah, I think when the HVS comes out, that will be helpful.
Yeah. Great.
Thank you. Following up on that, that was, you know, I was also really struck by the difference between Manhattan and the rest of the city. And one of the first things that came to my mind was that as I call from newspaper accounts, that many more people vacated their apartments during COVID. And this period is really at the depths of COVID, right? It ends in December, before the vaccines were available, when the economic fallout was at its most extreme. And I believe there were newspaper accounts about things like looking at post office address changes and things like that, which I believe were shown by neighborhood. I think it'd be interesting if we could collect that information to see how much of this may be due to vacancies as opposed to people, falling behind, on their rents. And I guess the other question is how much of this is about commercial the income decline is with a lot of, during this period, a lot of stores and businesses were shuttered, and I just really had a big loss of traffic. And I don't know how much of that also reflects, especially for core Manhattan. And again, I have no idea. This is just surmising. I think that the report just raises these questions because it's, obviously NOI decreased not just in Manhattan, but the headline number is driven in large part, I think, by Manhattan. And I think we need to really try to see how much of this is, a transitory, event because of COVID, and especially with regard to people moving out, or how much of this is more fundamental.
I just,
I'm sorry, Brian. Go ahead, and then Arpit, and then Christina.
I was just regarding your question about commercial income going down. You can certainly see that if you look at Appendix 11 in the report. If you look at core Manhattan, the total income went down 12.3% in core Manhattan, while rent went down 9.8%. But if you look at the city, excluding core Manhattan, total income actually went down at a smaller percentage than the rent. So they went in different directions in terms of the impact of commercial income on these buildings. And this report does reflect 2020. So beginning in March, so a good 9 months of this report, it reflects the impact of COVID.
I just point out a couple of things. One, it's reported, that's actually what the rent and income collected by owners, it's collection. So that's what we're looking at. So that's what reporting, they don't talk about vacancy, they don't talk about loss of rent, it's just collected rent and income. So from this data, to try to tease out the reasons why that's happening, we're not going to be able to do that. We could look at other sources and try to find that. Also, remember, we're looking at buildings with stabilized units. So in the buildings outside of Manhattan, a lot of those buildings don't have commercial space. So just bear in mind that, and this is why we always take core Manhattan as a separate entity. It's not the first time in the report that core Manhattan's acting differently than the rest of the city. So just bear those things in mind. There's limited things that we can analyze why these things went down. It's just, this is owner reported data for a large number of buildings and hundreds of thousands of units.
Yeah, I had kind of a similar
But
question.
Wait, I'm sorry, but it does include free market and commercial in the analysis, though, correct?
Yes, if
I mean, there are, and that's probably most of the deregulation had occurred in Manhattan. So that's going to have an effect. Yes, it does have free market units in it. You're correct, Rob.
Yeah, so I had kind of a similar question. So kind of the fact that income growth is kind of worse than rent changes would sort of suggest to me that it's possible that occupancy went down. But another possibility I'm wondering about here is rent non-collection. So as a result of the pandemic or the eviction moratorium, are there any trends that you've seen in rent non-payments among tenants?
Unfortunately, from this report, we can't gauge the trends. The decline in rents would include both vacancies as well as non-payment. So I think later on we'll be presenting other reports like the income and affordability study that will shed more light on that, I think.
Yeah, my comments also related to this fact that fair market units are included. It's logic that individuals in higher rental rate apartments, such as fair market apartments, have opportunity for much more mobility. So in the event of a pandemic, they can leave to go to another location, potentially, easily get into another apartment, such that their mobility as versus stabilized tenants is really night and day. And so, to have fair market apartments become vacant, thereby reducing NOI, driven by the pandemic, I think that needs to be kind of understood here. that the inclusion of fair market units in the data could be one of the reasons for the decline in NOI based on mobility.
I just like to make a couple of clarifying comments and then give some information. So the definition of a rent stabilized building in our reports means any building that contains one or more rent stabilized units. And as Andrew indicated, the core Manhattan buildings have a lower ratio of rent stabilized units because there's more deregulation, there's more, and then as a separate point, there's more 421A buildings, and they have a little bit of a different dynamic. The outer borough buildings and the non-core Manhattan buildings, they tend towards being more likely to be fully stabilized. So when we say that the data includes market rate housing, I just want to be clear, it doesn't mean it includes all the market rate housing in Manhattan. It includes the market rate housing that is contained in a building that contains at least one rent stabilized unit. So that's just for clarification purposes. And then again, for the new members, I just want to let you know that in past years, and it looks like this year as well, we have testimony by a couple of lenders. We've had the Rafael Sestero from the Community Preservation Corporation, which is a kind of a multifamily lender with a public service mission, as well as we had Mike Edelman from M&T Bank. And they were able to give us some of the context that people are talking about, the different behaviors of the core Manhattan buildings versus the outer borough buildings. And I think we'll be hearing from them. And it's not as comprehensive as the board's data. It's not citywide and comprehensive, but they both have very large portfolios of New York multifamily. So that's something that we will be looking at later in this season. Alex?
Yeah, another factor that comes to mind regarding the unregulated units within the buildings with rent stabilized units as well is that during COVID, it was reported that rents went down quite a bit in some of these market rate units. They've subsequently, at least the news reports say, have gone back up. But there was a period where people were moving out and finding units that where the rents had gone down. And I wonder if that's also reflected in this data. Obviously, we can't tell from the data, but it could be another factor during 2020.
Yeah, certainly.
Actually, Andrew, is there any way for us to look at reported rents? Is there some data source that we would consider reliable that would kind of, like at the beginning of the pandemic, we were terrified that we didn't have real-time data reflecting how bad things were for people and financially. And now we're kind of on the tail end of the pandemic, and now we don't want to rely too heavily on the data that's, I guess, equivalently stale from being at the height of the pandemic. Is there anything about where rents are that we think is really reliable that we can look at?
You mean currently or during this time period of the report?
Currently, like how much of a bounce there's been back in rents? Like I know, as Alex said, there's news reports, but is there a data source that kind of would show the rate of change of rent over time from like 2019 to 2022? Is there any of asking rents, even, like of asking rents, not of actual rents?
Yeah, I mean, the HVS, when that data comes out, will be 2021. So we'll have a better sense of what's happening there. And then, registered rents with HCR, we would have that information that we can take a look at. For the time period, it would just go back to 2021. And I mean, the only issue with current data, you can't tease out stabilized versus, market rents. So, you often see reports of, either from Street Easy or different groups that run these, but it's not saying that it's not germane to this board, but it's not capturing the tenant who's in place. And that is largely who we impact, is the tenant in place, because they're not renting that unit. It's a stabilized apartment where somebody has been there and their leases, the large majority are just renewing leases, not getting vacancy leases. So, but we will be able to examine some HCR data, and obviously HVS data will be more current than what's in this report.
I guess I guess I would add that, if it's really the market rate units that have had a decrease in asking rents, I would think that maybe the Zillow, Street Easy, and that kind of data might give some gauge, to what degree market rate rents had changed during the course of the pandemic and to what degree they've recovered, even if it isn't specific at all to rent stabilized housing.
Yeah, it's just another interesting factor in all this. So if you were in a rent stabilized apartment and your lease was renewed, offering a renewal at a lower rate means that you would now have that as your preferential rent. So I suspect that it would be harder to get a reduction in rent in stabilized apartments from an owner of units of stabilized, which is totally understandable, lowering rent, and then a market recovers and not being able to go back up to what the previous rent was. So that's somewhat of a factor in rent state, and maybe we're seeing some of that in the data, that we didn't see rent declines quite as much in the stabilized stock outside of core Manhattan. So that could be a factor as well.
Yeah, I would second that, Andrew, and say that most folks saw normal rental, RGB increases. I didn't see any preferential rents at all. And normally we do get a lot of tenants asking us, there's a difference between the, what they see on the top boxes and the preferential rent. And that wasn't my experience this year.
So Shayla, just
but also
go ahead, Rob.
No, if I may add, there's another layer that's come as part of the pandemic, which is ERAP, where if you have a rent regulated tenant, or any tenant for that matter, who gets ERAP, which is federal money that's being given to pay people who owe rental arrears, you can't charge rent increases if you've accepted that money, whether it's 12 months or 15 months or whatever the package that it's allotted to that specific tenant. That's A. And B is that if these rent regulated units are being re-rented, it's not as if pre-HSTPA you're getting a vacancy increase. You're not getting anything. You're getting a limited, whether it's 0.5%, 1%, whatever the renewal rate is all you're going to be getting on that.
Yeah, I think it's particularly next year in the 2021 data, I think we'll see the ERAP effect. And I also would say during that 2020, what we may be seeing is also was a very significant increase in unemployment for those who, so that I would imagine a lot went to paying rent. So people in stabilized apartments were probably, for the most part, the large majority were paying the rents due in part to that very significant increase in unemployment insurance. So that is certainly reflected in this 2020 data.
I mean, this is from an article in the New York Times. People were asking about the change in rent. According to Street Easy, in January 2020, before the pandemic, the median asking rent citywide was $2,900. It dropped 14% over the following year, climbing to 16% this past January to $2,895, which is $5 less than it was 2 years earlier. So it's obviously not necessarily in rent stabilized buildings, but it basically shows at least the market rents returning to what they were 2 years earlier.
Alex?
Following up on Rob's comment about ERAP, emergency rental assistance, I think those are important points. The other, though, is that to some degree, landlords will be reimbursed for rental arrears. And I don't know if it's possible to take that into account, and probably will, and I don't know for next year in terms of the next income and expense report, will the ERAP funds be reflected as a source of income for the landlords? But so in other words, to some degree, when tenants receive emergency rental assistance, ERAP provides back rent, right? So to some degree, landlords will be made whole when tenants have fallen behind. This data will not reflect that at all, but presumably the 2021 data a year from now might. And I guess so I just pointing out that to some degree, the arrearage will be reimbursed. And also, is that reimbursement going to be reflected in this data set going forward?
I suspect it will. I mean, it's a good question for finance if they're going to somehow tease that data out separately, because those are based on, that's how they assess the buildings. So it'll be interesting if they add something to the next RPIE. I haven't looked to say that this is money that was in arrears. It's not reflective necessarily of the true value of the building because there is a income component to the assessment. So it's certainly something that I can ask finance whether that would be reflected in the next go round. And just a teaser, we will have ERAP data for the INA. So we'll take a look at what's been handed out. So
great.
That's just a teaser.
That'll be helpful on ERAP front, just as an overview. ERAP covered a maximum of 15 months rent. And that's if at the time of application, the tenant had 15 months of arrears. If at the time of application, the tenant was 6 months behind, that was the amount applied for, and that was typically the amount received. And as we know, the pandemic extended, beyond 15 months, 18, 20. I don't know what a consensus is on how long the pandemic was, but I would say, collections during the pandemic, probably, from the feedback that I'm getting from owners, was the worst and continues to be the worst in the history of ownership of buildings for obvious reasons. Rent is the biggest expense. We had a pandemic, lots of job loss, but I'll be curious to see what the impact is of actual collections, ERAP, et cetera.
Andrew, on the ERAP point, you already spoke to this, but just to be clear, these are the questions that come to mind for me for ERAP, which is, who receives the ERAP funds? Is it like the beneficial owner of the property, or is it like, so if a large landlord gets ERAP funds, will it get allocated in their income and expense reports, in their RPI reports to HCR? Will be reflected on a building by building basis, or will somehow it be allocated to some larger corporate entity? So where does that money get allocated on I guess legally, who gets that money, and then how is it reflected? And then along the same lines, is there some way to kind of look at the total amount of ERAP monies that landlords received, and then try to get some per unit interpretation of how much each unit got? So in other words, what can we tease out from ERAP to make sure that we're allocating the right amount to the building stock? That's what I'm trying to get at.
Oh yeah, that's easy.
Can I jump in?
Yeah, please.
To the first part of the question, I don't have an answer, but I can't imagine they would just, accounting wise, I don't think it would just get reported to some big corporation and not to the individual building, because it is income for that building. I can't say 100%, but that wouldn't seem to make sense from an accounting standpoint. I do have information about the average benefit per household receiving it. That doesn't say how many months it is. So I can't tell you, like, this is 6 months of rent and, it equaled a total of $10,000. So that means it's whatever, $1,500 a month. That I can't say, but I do have the average benefit amount that each of these households received.
And just to your point, David, just the RPIEs feel they're by building. So if they're required to put that ERAP as income or rent, then it would just be on an individual building basis from the data that we get. I don't know how tease it out, but I'm very curious. I'll have to talk to finance. I'm very curious if they'll have a separate, because from their standpoint, it's about assessing the building. So I'll see what their plan is.
Jayla and then Christina.
I was just gonna say that we helped a lot of people apply for EREP. So yes, it is a total 15-month timeline, but folks were able to also tap back in. There is a process of reopening your application and seeing if they'll cover more. If they didn't cover the first full 15 months it's the max. The other thing is that we are only focusing on ERAP, but there are other ways that people get back rent paid, like one-shot deals, other services that we'll start to see more of. And then ERAP, there's conversations on the state level to allot more money towards that to also pay more back rent. So even if there is back rent that's owed, I think that there is going to be some relief for those owners as the state responds in this budget. And we're hearing that on the ground. So that I feel like there is a lot of moving pieces still, even data that we get from what happened in 2020 or in 2021 is going to be lacking because all those folks who are still owing rent. What we've heard from like state agents, city agencies is, one-shot deal, apply for ERAP first, see how much they'll cover, and then come back to us is what we're hearing. And then same for like other charitable donations, we're hearing the same. If you haven't applied for ERAP or a one-shot deal, they're not going to consider you yet because they're waiting to see how you get relief in other spaces, specifically because it was such a large amount from the federal money coming into the state. So I think that we'll see how that shakes out as like time goes on. But I think what we heard in real time in 2020 and 2021 from the banks where we aren't seeing any crazy things happening. And so I wonder what happened between last year when we voted and the last few and like the remainder of the year and see how that data actually teases out, because we didn't hear anyone running around with their hair on fire or and then we heard about ERAP. We're seeing ERAP also potentially come back. One-shot deals, I don't know how that's going to shake out. I'm actually really interested in see what data the staff puts together on it to see what like the actual non-payments are. But for us on Housing Corps, we're seeing over 200,000 evictions have been filed. And so there's like a wait log. I don't know if that means that some of them did get ERAP and those cases will not be calendared. I think it's hard to like tease out what that actually looks like as well.
Christina?
Just a point about, and this sort of supports what Danielle had mentioned, and, in terms of receipt of ERAP funds, owners were required to set up a separate email for each building, and each building is its own entity. For the most part, it would be rare to have an owner have a building or two buildings in one ownership entity. So it's clear that any ERAP went directly into the operating account of the landlord, keeping all of that separate. So it will be allocated as income. Hopefully, dollar for dollar income, but that's as Sheila said, still TBD. If a tenant has exhausted all their ERAP potential, there are some backup measures, certainly. But it's important to note that, the first ERAP award or restitution probably, maybe someone can correct me, but probably happened around September, October of 19. And so the regulations on the program freeze an owner's increase for 1 year from the date of receipt of funds. And so that, certainly on stabilized increases, right? If a renewal goes into effect during that 1 year ERAP increase ban, there will not be, an increased percentage according to RGB on those leases. So that's sort of an added, implication. They make our lives so much easier, don't they, on the board here? But so we're looking at some of the income numbers certainly going to be impacted by that rent freeze caused by the receipt and the acceptance of ERAP, which was one of the requirements of the program.
Christina, can I just ask a couple of clarifying questions to what you said? Because I think it does get us a good part of to answering Alex's question. But you referenced 2019. Do you mean 2020 that the ERAP first went into effect in 2020?
I have lost complete track of when the pandemic started. Yes, it was March of
Pandemic time.
2020.
Yeah, it was
Yeah.
2020.
Okay,
Yeah.
thanks for that clarification. I'm trying to forget it all together. But yes, March 2020, so that's September 2020. And maybe Sheila, you might know better when the first rounds of the ERAP funds started to come in.
Oh yeah, Christina, I just wanted to ask before we go to Sheila, just one other clarifying question. You mentioned that there's the 1 year rent freeze that landlords agreed to as part of ERAP. But and just to clarify, it doesn't mean that you can't take the rent increase from the Rent Guidelines Board. It's just that you can't take it until that 1 year period is done. Is that correct?
Exactly right. That's
Okay.
exactly right.
All right, and then just as a reminder for new members, I mean, you probably know this, but our increase for the 1 year was a 0% for the first 6 months. So there may be a good amount of overlap of 0% from last year's adjustments with the ERAP rent freeze, but not in every single case, but just as a point. But then Shayla, I'm sorry, I kind of cut the line.
Oh, I was just gonna say that I think that I think there will be overlap, but I think the point that is being made might be that there is an overlap of 0% increase. But for me, the point is our increases might not actually have the impact we think they will this year. Therefore, we should be really strategic about how we do those increases based on like what data we actually have. For me, that actually says that our increases, if we do any adjustments we make, if there is an increase, the increase won't have the impact that maybe everyone on this board might want it to have. To me, that signals that we should be on the lower scale until we see what data comes in. The banks weren't running with their hair on fire. We didn't see any. The data right now is looking like what I think the state laws were intended to do in 2019. And so to me, it's a little bit like we're just looking at data that's reflective. I want to see what's happening with one-shot deals. If landlords are made whole, or most landlords are made whole with with ERAP and one-shot deals, then I think that paints a picture of like the housing stock is stable. The pandemic did impact, but as the city and state have done, we're corralling around in a way that like makes sense and it seems strategic to me.
Danielle and then Christina.
I just wanted to clarify the dates around the ERAP. There was an earlier program through the state, funded by the state, administered by DHCR. I don't believe they had these same requirements about freezing the rent. They did not distribute that much money. The ERAP program started taking applications, I think around July of 2021. And they basically closed the applications in September, October, because they had allocated all of the money already. Now, not all of that money has been distributed because they allocated some money that's pending landlord information before it can be actually distributed. So while all the money so far has been allocated, it hasn't all necessarily been distributed, but in any case, it didn't start to get distributed until the second half of 2021. And the state is requesting more money. They did get another 100 or 200 million from states that didn't use their money about a few weeks ago, but they requested, another couple billion. And I don't know if that's going to happen or not happen.
It could also be a part of the state budget. There was talk of that, which hasn't passed. So they were waiting what the federal response would, but there could be money allocated in the state budget that's due April 1st, I think. But that's probably not.
Sorry, Christina, not trying to skip, but I just wanted to comment on that because remember that there was only 30 days open from that first initial in 2019. They only opened the application process solely online for about 30 something days. The tenant movement sued and they were required to reopen ERAP again to see what the need was. And that's where the demands around the ask for more money in this current budget are based on who we think will apply to, to make sure that everyone is able to, as many people are able to stay in their homes based on the decisions that were being made. So it's just, I just want to make sure that those distinctions are highlighted, because the closing, then people thought, oh, I don't have access to ERAP now. Then it was open again. Folks applied, and applying in the application also triggers people's ability not to stop an eviction process. So if you are applying an ERAP, it stops the eviction process until you figure out what's going on. So that process is still, like, folks were still applying even though we understood there was no money left. And so if there is money allotted again, I feel like it's going to go really fast, but it'll give us insight on exactly if there's gaps on people's ability to pay rent.
Christina?
It was really more pointed to the timeline of the receipt of ERAP. So July 21 being the start, we'll be in a sweep of the ban on increases well into 2023, which certainly needs to be addressed in terms of our future votes and increases. That's the only comment.
Mm-hmm. Alex?
This is a little bit of a tangent, but there's 2 points. One is, I think we have to remember that the emergency rental assistance only relates to arrears, other sources of income loss, vacancy, and changes in commercial income. That's not reimbursed. The other thing I was thinking is, last year we collected data on sales prices of rent stabilized housing per unit, which we didn't do before. And I think it's really important if we could do this again, because it really shows what the market what the market standing is for rental housing right now in light of COVID and in light of the rent stabilization changes in the legislature in 2019. So I think it's important to see, are prices, trending down? Are they stable? Are they going up? When you looked last time, there wasn't a huge change, as I remember. But I think it would be important to look at that again, because it's sort of a real-time indicator of how investors are looking at rent stabilized housing or housing with rent stabilized units.
That data will be part of the mortgage survey. So we
Great,
will
thank
have
you.
it by unit. I just also wanted to point it out that we requested from finance, and we've recently gotten the data, and we'll have to take a look to make sure it's all correct. But we just took income, rent, expense, and NOI for buildings that are entirely rent stabilized. So we'll be able to compare citywide versus just buildings that have stabilized units. So it should be it should be available this month. So we'll write that up and include that as part of a memo. But we're working with finance to make sure that the data runs are correct. So we were hoping to be including it as part of the report, but I'm very hopeful that we can get that to you in the next 2 weeks or 3 weeks.
Particularly for the new members, I'm just following up on what Andrew said, just to kind of give you some insight into how some of the factors that I take into account as we work towards a proposal. We have a very the tool we have it has to apply to every unit. We have the increase for the 1 year and the increase for the 2 year. And so on one level, what we're looking at is the median or the average property, depending on what you're looking at exactly. But I think one thing we need to be sensitive to is, are there particular parts of the housing stock that are really going to face a lot of distress? And for the last few years, the part of the housing stock that we've talked about a lot is kind of your outer borough, 100% stabilized or 90% stabilized building with no commercial space on the ground floor, no parking to generate additional rents. And so in looking at that 100% stabilized stock, which is a very large portion of the stock, It's to kind of make sure that we're not that we're not forgetting about kind of a part of the stock that is not represented as the average, but that is a very meaningful, important part of the stock that we want to protect. And then, on the other hand, when we think about Core Manhattan, and we realize that they've had ups and downs, what tools does Core Manhattan have to address previous losses? They have, the anecdotal data that rents have increased. They have potential commercial space or not potential commercial space because there's a lot more commercial vacancies. But our analysis of the different components of the stock may differ based on their very serious different characteristics. Other questions from board members? Brian, could you just, I just have one other thing. Again, this is just kind of sharing my thinking a little bit. Could you pull up the slide with NOI over time? Because for me, and I think for other members as well, kind of NOI is kind of an important indicator of the health of buildings. And for our new members, I kind of want to share my thinking on that, which is it's really the higher NOI creeps up, the more likely a building is in distress. And to take the extreme case, if all of your income is being used for your expenses, or more than your income is being used for expenses, then obviously you're in distress. That's a distressed building by definition. But the higher it goes. I'm sorry, Brian. The slide.
Sorry, which slide?
The slide with NOI, not how much it's increased, but what it is over time. Like 60. That
this one.
Not the growth, but actually just net operating income over time. I think there's a slide that says that. Am I wrong?
With the numbers or graph?
The ratio of the graph.
This one, I think, is the only graph.
That's how much NOI has increased, but
the one with the bar chart?
Maybe it's the bar chart.
Well, that's PIOC.
No. All right. Well,
I don't know.
I'll just make my point. I don't need the graph, which is just looking at the ratio of expenses to income is a good sign of how the median building is doing. And if expenses really go up dramatically, that makes me worried about the health of the housing stock. If they go down dramatically, then that means that those buildings are flush with cash. And so that for me is a pretty big indicator of kind of the health of the housing stock, and something that kind of informs my own personal decision and what I think we should be doing. So I just wanted to share that, and others will come at the data with different priorities, but I wanted to share some of mine. Okay. So Andrew, do we want to kind of give a heads up that what we're going to cover at our next meeting, what we expect to do at our next meeting?
Yeah, currently on the slate, we have the mortgage survey report and the price index of operating costs. And that we do have in line a guest speaker from M&T Bank. Michael Edelman's going to come back because we're doing our mortgage survey and discuss what they've witnessed over the past year. And that will give us a good insight, I think, on what type of vacancy collection losses or rent declines or increases they've seen in their particular portfolio. And he probably can discuss that within, or he should be able to discuss that within Manhattan versus, what's going on in the other boroughs as well. So.
Great. So I just want to conclude by saying thank you all for agreeing to serve again.
Sorry.
Oh, Shayla, you have.
I have
Go ahead,
questions.
Shayla.
Just One question is, we haven't talked publicly about our public hearings. And when we're thinking about holding them, how we're gonna hold them. And I wanna make sure I think we're expecting people to be able to go to court and fight their evictions. I think that they should have the benefit of also testifying in front of all of us. I don't necessarily feel that we need to do our the hearings, that presentations in person, but at minimum, giving tenants the opportunity to testify in person. So that is something I wanna communicate to everyone and make sure that's something we're centering as we go through this. And I think that we should go back to our same model. Folks traveling for an hour to go into Manhattan isn't something that feels feasible, and we should go back to our standard of having auto borough hearings and having our hearings the way we used to pre-pandemic, as we're expecting New York to work full-time in person and go back into in-person work and fight evictions and apply for one-shot deals and get support for ERAP in person. And so they should have also the venue to testify in person. And so I hope that we can have conversations about that and set public dates for everyone.
Shayla, I'm going to propose that we put that on the agenda for our next meeting for a couple of reasons. One is Andrew has been speaking to potential venues, and their policies in terms of vaccinations and showing IDs. Things are a little bit up in the air. And I think it's going to require a little thought about how to make that work so everyone is happy. I'd also like it if we had our full complement, our ninth member here as well. Does that work to put this on the agenda for our next meeting?
I think so.
Okay, great. Any other comments or new business that anyone would like to raise?
In terms of the schedule I sent around earlier, I didn't hear back, so I'm assuming those dates work for folks. I know
Andrew, that means that we're going to go with
if you've already discussed with me that you can't get that, I know that, so you don't have to bring that up. But for the most part, I just wanted to make sure that that schedule works. Okay, let me know if it doesn't. So we want to start making some more of our meetings public. So,
Andrew, do I remember correctly that version of the schedule had either April 20th or April 21st?
It's definitely April 20th.
Got it. Okay, thank you.
So we can have our full board here. So April 20th, which is a Wednesday. Mixing it up.
I'll get back to you on the 20th. I didn't notice that it was the Wednesday change.
One board member will be out of pocket that on the 21st. That was why we were looking at the 20th.
Yeah. So okay.
Did you notice the final vote's June 27th? Is that official yet? Or I just don't know if I'll be available that day yet.
Ooh, okay. That's a discussion then we should have.
We definitely just for the new members, the 2 days that you should be here come hell or high water are really the preliminary vote or the final vote. So let's make sure that those 2 days work for all of us before we finalize them.
Yeah, I mean, I think if it's remote, that's one thing, but if it's going to be in person, that might be a little more challenging.
Okay.
Sorry, can I, just going back to the final vote, in the schedule that you guys sent out, and Andrew, you can correct me, the 27th feels like really late in the month.
Yeah, the reason why
the world, what if something happened? It seems like then we would have, I mean, we
yeah,
have to
no,
where everything
well,
happens.
the reason why I mean, we can revisit this, but the reason why I pushed it later, because my years of experience with a switch in administrations, that the season tends to get pushed back. And so I wanted time between the preliminary and the 30-day comment and to be able to have public hearings. So that's why I would be open to switching that, but that was the thought. I mean, we have done voting meetings that late, but I just wanted room for us to maneuver. So.
I mean, by law, Shayla, I mean, you're right, Shayla, but by law, we need to file our adjustments on July 1.
Yeah, with the city.
We
club.
have a
Yeah.
little bit, I mean, not much, but a little bit of time. And then I guess there's always the possibility of going virtual. Yeah, I don't know. I mean, that, whatever, that's a whole
Well,
other.
I'm less concerned now because the rent laws aren't expiring. So I feel like that isn't gonna throw a wrench in our deliberations like it did that one year, 2019.
That's
So
right.
I feel like less concerned. My
July 1st is a Friday. I was just looking. Because if July 1st was a
Monday.
was a Saturday or Sunday, I get the next day. It's the next time the city clerk is open. So there can be an exception to that, but July 1st is on a Friday. I mean, knowing this process, I don't see a problem getting it filed by July 1, but I don't think that 27th would be pushed because simply because you're right, the law isn't being renewed. In fact, just an FYI, the Albany session ends June 2nd this year because there's primaries this June. So normally it would go to the middle of the month, and that was what Shayla is referring to. It was always the 15th, and then it was never the 15th because it was pushed back. But since the law is not going to be renewed or any time ever from the way it's set up now, that I don't foresee those types of issues going forward. But yeah, look, if yeah, but if we need to, Christine, I'll talk to you and see where you're at with, we can do that off. Let's see.
I can do the 20th. Is that supposed to be?
No, the 20th is just another meeting. So
Okay.
just that we
Not the
have
invited one.
right.
That
So
was a
the invited
switch.
one is the
Okay.
26th, would be April 26th, which is a Tuesday, Shayla. So it's a Tuesday. But we added another meeting in there from what we initially sent out because the income and affordability, we had some hopes of possibly getting some HVS data. So we pushed that back, and it would have made the meeting on the 14th very too much, I think, intensive data. I think so. Just adding another meeting, I think, made it. Dave and I thought it just made it easier for everyone to sit through that and digest the information. So the INA will be presented on the 20th.
Now that we're talking about dates, I was going to talk about this offline, but we may as well do it here. So far, I can make the May 2nd preliminary vote, but I will be flying in that day. I should be arriving at 1 p.m. or something like that. But just in case, is there any possibility of moving it to May 3rd? Just to, have plenty of wiggle room for any delays or anything like that, if possible.
Okay. Well, I'll have to look into that. So.
Okay. Thanks.
Maybe we leave this until the next meeting, David, but the other point was, what are we going to stick to virtual for the preliminary vote and the final vote? Like that is like one of the moments that most people engage with us. And so that feels like another moment for us to be in person. So I would like to open discussion for that. And I know, Christian, that might actually made the 3rd even a more appealing date, but that is something that I think I would be pushing for. I'm going to encourage my tenant rep, and folks in the tenant movement are also asking for.
So Shayla, yeah, so along the same lines, and I'm going to ask Andrew and the staff to kind of look at, what is the governor saying about the Open Meetings Act, and kind of we'll get a full report about what our options are, and then we have to make a decision as to what makes sense, what people are comfortable with, what makes sense for us, what makes sense for the public, and let's have a full conversation on that on the 14th. Okay, hearing no other new business or questions. So I'd just like to say, and one of the reasons that I really enjoy serving on this board is just that the level of conversation is so high, that the expertise that you all bring to this is kind of extraordinary, and that no one of us could know everything about this subject that us as a group of 9 board members and 3 staff bring to this. And so I'm just looking forward to having these kinds of conversations for the rest of our season as we come to our preliminary vote and ultimately our final vote. So thank you again for your service.
You have to do a motion to adjourn, David.
As always, I forget the motion to adjourn. I leave on a high point and then I forget. But do I hear a motion to adjourn?
A motion.
By Alex, a second.
A second.
A second by Christian. We're adjourned and I look forward to seeing you soon.
Bye, everyone.
Thank you.
Thanks, everyone.